The Roman Empire didn't fall to barbarians. It drowned in debt first. By 250 AD, Rome's military spending consumed 75% of imperial revenue, while tax collection collapsed by 60%, creating a deficit spiral that devalued their currency by 98% in just 70 years. Most people believe Rome fell because of external invasions and moral decay. But the empire was already a financial corpse by the time the Goths arrived, hollowed out by the exact same debt trap now strangling modern governments. In 33 AD, Rome faced a debt crisis so severe it triggered the first recorded financial panic. With interest rates spiking from 4% to 12% overnight, credit markets freezing completely, and the Emperor Tiberius forced to inject 100 million sesterces of emergency liquidity to prevent total collapse. Sound familiar? In the next 10 minutes, you'll discover how Rome's addiction to borrowed money transformed the world's wealthiest superpower into a bankrupt shell, why their desperate attempts at stimulus and debt monetization accelerated the collapse instead of preventing it, and most critically, the 3 specific financial positions you need to take right now, because the United States is following Rome's playbook with terrifying precision, step by catastrophic step. Welcome to Rome 33 AD, the 18th year of Emperor Tiberius's reign. The empire appears invincible, controlling 2.5 million square miles, commanding 450,000 professional soldiers, and generating annual revenues exceeding 825 million sesterces. But beneath the marble facades and military might, a financial time bomb is ticking. For 3 decades, Roman aristocrats have been borrowing heavily to finance everything from political campaigns to speculative real estate investments, creating a debt bubble that now exceeds the empire's entire annual tax revenue. The lending system operates simply. Wealthy senators and equestrians lend money at legal rates, initially capped at 12% annually, secured by land, slaves, or commercial enterprises. But lax enforcement has allowed rates to creep higher, and borrowing has exploded beyond any sustainable level. The crisis erupts in spring 33 AD, when Tiberius, responding to populist pressure about predatory lending, suddenly enforces a long-ignored law requiring that 2/3 of every senator's fortune be invested in Italian land rather than loans. The law aims to reduce debt dependency, but it triggers catastrophe. Creditors, now legally obligated to recall loans and shift capital into land, simultaneously demand repayment from thousands of debtors. But here's the trap. The loans don't exist as cash. They're accounting entries. When everyone demands payment at once, there isn't enough currency in circulation to satisfy the claims. Debtors can't pay. Asset prices collapse as forced sales flood the market. Credit freezes entirely. Interest rates spike from 4% to 12% within days. Prominent families face ruin. Senator Publius Spinther, who borrowed 60 million sesterces against his estate to finance his son's political career, watches helplessly as his property sells for 25 million at forced auction, not even enough to cover his debt. He commits suicide within the month. The panic spreads like plague. Banks close, construction stops, trade routes seize up, unemployment spikes as businesses can't access credit for operations. By May, the Senate begs Tiberius for intervention. The emperor responds with history's first recorded government bailout. He orders the treasury to distribute 100 million sesterces in interest-free loans for 3 years, secured by land worth double the loan value. It works temporarily. Credit flows resume, prices stabilize, the panic subsides. But Rome has learned a dangerous lesson. When debt becomes unsustainable, the government will intervene. This moral hazard will define Roman financial policy for the next 3 centuries, ultimately destroying the empire from within. Tiberius's bailout provides only temporary relief. By 200 AD, Rome faces a far more catastrophic debt crisis driven by military overspending that no emergency fund can fix. The empire's borders stretch impossibly far, from Hadrian's Wall in Britain to the Euphrates, river in Mesopotamia, requiring 33 legions, nearly 200,000 soldiers, plus equal numbers of auxiliaries. Each legionary costs the treasury approximately 1,200 sesterces annually in salary, equipment, and supplies. Do the math. 450,000 troops, x 1,200 sesterces, 540 million sesterces just for military wages, consuming 65% of imperial revenue before accounting for infrastructure, administration, or grain doles feeding 200,000 Roman poor. The equation doesn't work. Tax revenues can't keep pace with military costs, so emperors turn to the ultimate cheat code: currency debasement. Under Augustus, 27 BC, the silver denarius contained 95% pure silver, nearly 4 grams of precious metal. By Emperor Septimius Severus, 200 AD, it contains 50% silver. By Gallienus, 265 AD, just 5%. By Aurelian, 274 AD, virtually zero. A bronze coin with thin silver wash that rubs off in your hand. The government is literally paying its debts with fake money, inflating away obligations by destroying the currency. Prices explode. A modius of wheat, 8.7 liters, costs 8 sesterces in 150 AD. By 301 AD, it cost 200,000 sesterces. A pound of gold that once bought 72 pounds of wheat now barely buys a loaf of bread. The military gets paid in worthless currency, so soldiers mutiny, assassinate emperors, auction the imperial throne to the highest bidder, literally in 193 AD. The Praetorian Guard sells it for 25,000 sesterces per soldier. Ordinary Romans watch their savings evaporate. That retired legionary who saved 20,000 denarii over 25 years of service. By 280 AD, it won't buy a week's food. Farmers refuse to sell grain for worthless money, demanding gold or barter. Cities face starvation. Provincial tax collectors can't collect enough to fund garrisons, so frontier defenses collapse, and barbarians pour through undefended borders. The empire fragments, with breakaway kingdoms forming in Gaul and Palmyra. Emperor Diocletian tries price controls in 301 AD with his famous edict on maximum prices, fixing prices on over 1,000 goods and services under penalty of death. It fails spectacularly. Goods vanish from markets, black markets flourish, the currency keeps dying. Rome's debt trap has triggered a death spiral. Military spending they can't afford, currency debasement to pay for it, inflation destroying what they do collect, requiring more debasement, accelerating collapse. By 300 AD, the empire that once generated 825 million sesterces annually can barely feed its army or defend its borders. The barbarians didn't destroy Rome. They simply walked into the ruins of an empire that had already bankrupted itself. Now fast forward to Washington, D.C., 2025. The United States national debt exceeds $36 trillion, 138% of GDP, the highest peacetime ratio in American history, excluding the immediate post-WTO period. Federal spending outpaces revenue by $1.7 trillion annually, requiring the Treasury to auction new debt continuously just to fund operations. Sound familiar? Rome's military consumed 75% of revenue. America's defense budget plus entitlements, Social Security, Medicare, Medicaid consumed 70% of federal spending before adding interest on the debt itself, which now costs $1.1 trillion annually, more than the entire defense budget. Like Rome in 250 AD, we face the identical impossible equation: commitments we cannot afford funded by currency we're systematically debasing. The Federal Reserve's balance sheet expanded from $800 billion in 2007 to $9 trillion by 2022, and 100% increase in just 15 years. This is modern currency debasement, not by mixing copper into silver coins, but by creating trillions of digital dollars through quantitative easing, the euphemism for monetizing government debt. The result? Your dollar lost 23% of its purchasing power since 2020, the fastest decline since the 1970s stagflation. Rome debased to pay soldiers on distant frontiers. We print to fund wars in Afghanistan, Iraq, and now military commitments across 85 countries while running trillion-dollar deficits. The pattern is identical. Rome tried stimulus, Tiberius's 100 million sestertii injection. We tried stimulus, 5 trillion in COVID spending plus 1.9 trillion American rescue plan. Rome tried price controls, Diocletian's edict. We debate price controls on rent, drugs, and food. Rome's currency became worthless, despite government insistence it held full value. Our government claims 3% inflation, while your grocery bill, housing costs, and insurance premiums tell a different story. Real inflation for ordinary Americans runs 8 to 12% annually. The bond market is flashing warnings, 10-year Treasury yields spiking, debt auctions requiring ever higher interest rates to attract buyers, foreign governments, China, Japan reducing their holdings of US debt. When your creditors lose confidence, you're entering the Roman endgame. The only question is timing, and whether you'll be positioned like the Roman aristocrats who converted to hard assets before the collapse, or like the retired legionary who trusted the system until his savings became worthless. So how do you survive and thrive when empires drown in debt? 3 specific strategies the Roman wealthy used to preserve fortunes across the collapse. First, convert debt-based currency into debt-free hard assets immediately. The Roman aristocrats who survived owned land, productive farms, vineyards, olive groves, assets that produced real value regardless of currency worth. Modern equivalent: allocate 15 to 25% of liquid wealth to monetary metals, physical gold and silver. Bitcoin, algorithmically capped supply governments cannot inflate, and income-producing real estate in supply-constrained markets. When Rome's denarius went to zero, those holding coins were destroyed. Those holding farmland continued eating and selling goods. When the dollar loses reserve status, not if but when, physical assets that produce real value will survive the transition. Second, position yourself as the borrower, not the creditor of doomed currency. This is counterintuitive but historically proven. During currency collapse, borrowers win and lenders lose. If you can secure long-term fixed-rate debt, 30-year mortgages at 6-7%, on appreciating hard assets, you're borrowing today's strong dollars and repaying with tomorrow's inflated weak dollars. The debt evaporates in real terms while your asset appreciates in nominal terms. The Romans who owed money to creditors in 250 AD and repaid in worthless 280 AD denarii effectively paid pennies on the denarius. Strategic debt on productive assets is a hedge against currency debasement, but only if the asset produces income greater than debt service in any currency environment. Avoid consumer debt entirely. Embrace strategic debt on hard assets. Third, develop crisis-proof income streams outside the debt-based system. When Rome collapsed, the people who survived were those with skills and production capabilities that transcended currency. Farmers, craftsmen, merchants with international trade connections, soldiers who pivoted to private security. Modern translation: build multiple income sources, develop location-independent skills, remote work capability, technical expertise, professional services, create international revenue streams in multiple currencies, invest in businesses with real pricing power and hard assets. Your W-2 salary denominated in debasing dollars is a single point of failure. Eliminate that vulnerability. The Roman bureaucrat with a fixed government salary was destroyed. The merchant with diverse trade relationships across provinces survived. Start this week. Calculate your exposure to dollar-denominated paper assets, cash, bonds, fixed pensions, versus hard assets and diversified income. If you're over 60% in paper, You're positioned like Romans holding debased denarii in 280 AD, trustfully waiting for a system that's already dead. History doesn't repeat, but if you don't understand it, it will crush you all the same. Subscribe now, because next week we're exposing the 3 specific fiscal metrics that signaled Roman collapse exactly 18 months before the empire fragmented, and why 2 of those 3 indicators just flashed red for the United States in Q4 2024. The pattern is undeniable. Your choice is simple. Position yourself accordingly, or learn this lesson the hardest way possible.